Alright, in this video I want to cover two things regarding net present value. First would be how to calculate it just using a basic function in Excel, and second will be a couple notes on what it is and how it is used in the industry. So let's get right into it. The first thing of how to calculate net present value would just be a basic equals NPV function. So the first thing is you're going to have these cash flows. It'll be, I'm just assuming, 10 years worth of cash flows for Hamza's clothing company and a $5 million initial investment here. So we're assuming that along with 10 years worth of cash flows. This would be free cash flows after all taxes and expenses. So we would calculate out equals NPV using our discount rate of 9% assumed here, and then we would use the 10 years worth of cash flows and press enter. But we have to still add our initial investment, but that would be outside of the formula. We add that initial investment to it since we do not want to discount that initial investment. Since that's in year zero or at the starting point, it's not discounted. So you just add that first and then have your net present value function, and that'll just be your basic net present value. It's a pretty simple function, a pretty basic calculation here. For those of you who didn't know, and if you want to then break it down even further, assuming that this is a public company, you can say that maybe we have 500,000 shares outstanding, and you figure out a share price there. You take the net present value and divide your assumed shares outstanding, and you could get a share price if this was a public company traded on the stock market. So now just going a little bit further into what net present value is. So what we just did here would be the most basic form of a discounted cash flow model. We are just assuming that we have 10 years worth of income and we have an initial investment. So that is just a basic discount cash flow model. It's just assuming or predicting the future cash flows of a business and then discounting them with a specified discount rate. Your discount rate is a calculation to factor in either the opportunity cost and or the risk of an investment. So if you're using an opportunity cost perspective, you are assuming that 9% is what you would get somewhere else in the market. So if you're looking for a similar investment, let's say you're starting out with $5 million, like in this example. So you're assuming that I can go somewhere else in the market or somewhere else even in the private markets and find a company or an investment that will give me a 9% return per year. And that is why we're using that discount rate. So if you think that you have an opportunity that rather than put your money into Hamza's clothing company, you can just put it somewhere else and gain 9%. That would be that's why you would use a 9% discount rate. So now the second half of that discount rate would be the actual risk of an investment that you take. So if you're assuming that your discount rate is solely calculated based off of risk rather than the opportunity cost, then you're going to factor in perhaps calculations like inflation. Inflation would be one risk. Let's say you're assuming a 2% or a 3% inflation. That would be the first basis. You would use the treasury rate as another addition to that inflation rate. So let's say a 3% treasury rate on top of a 3% inflation rate, and then the company specific risk. So you would have something like that's going to be a complete assumption, but that's where you would say 3% for this business because it's a risky clothing business, maybe 5%, maybe you use like 15% for this business. It depends, and it really, that is the difficulty of building out a discount cash flow model, and why so many investors can disagree on the actual value of a business, because one main factor is going to be the growth rate of your future assumed cash flows, and another factor will just be that assumed discount rate will because if you're assuming that this company has a 14% discount rate. One investor thinks it's risky, so they assign it a 14% discount rate, but someone else assigns it a 16% discount rate. You can see how that factors into the actual NPV and into the share price there too. So just doing that again, like a 14%, we got $4.03 of expected share price, a target share price, and then using 16%, you only get a 287 share price. And now just moving on to a more general perspective of why we use discount rates and why we use net present values in finance here. And that is just from the basic perspective of the basic concept of a dollar today is worth more than a dollar tomorrow. And that's because you can invest that money that you have today. So if you have $5 million today, you would rather take that money and utilize it today to your advantage, invest it somewhere, and produce a given return. If you got this $5 million, 10 years down the line, it doesn't do you as well, because you wouldn't be able to get all of these cash flows over those 10 years. Whereas if you just have it on year zero and at the initial investment point, then you're able to get these cash flows because you can invest the money. And it's a very simple concept, and that's why in finance the discount rates are used and net present value is used. I know it's a little bit weird at first when you're learning of why would I just not add up these cash flows and just say, this is my discount rate, right? Or this is my cash flow right here. This is my return on my investment. I put in $5 million and I made out with $14.5 million. Why isn't that my return? And that's because if you have to factor in discount rate, you have to factor in the risk of the business, you have to factor in your opportunity cost, you have to factor in inflation, you have to factor in the treasury rate. And when you actually calculate all those and factor it into your investing, then you end up with this actual net present value, and that's the real, just like how in GDP you have a nominal and a real calculation. That net present value is sort of your real adjusted calculation of the return on an investment. So there is just a little bit about net present value. If you like that video, please give it a thumbs up, and please subscribe to the channel. Let me know in the comments below what you would like to see next. Thank you and have a good day.